Hey guys, what's up? Alec back with the daily stock market. And look at that. In the past 3 months, we're up 8%. So we're falling a little bit from our all-time highs. Here we're up even like 20% at one point. So we were absolutely killing it. And still in the last year, we're up 54%. We're in a little bit of a downturn right now, in a downtrend, but that's okay. Because if we look at what happens every time I account in a downtrend, it always goes back up. So if you look at all my other downtrends, it's actually very typical to have a downtrend in your account. As long as you buy the dip, then your account should be absolutely fine. Now, I know a lot of you guys don't have big of an account as I do, so what this video is going to be about is 5 stocks under $10 to add to your watch list. So it's going to be more affordable stocks under $10. And then we'll probably even do another video next week under $20. And then the week after that, we'll might even do under $30. If you want to see exactly what I'm buying and be a part of my private group, DM me on Instagram. I have a few more spots to fill. But let's get right into the video. All right, guys. The first one that we're going to be talking about is BNGO at $5.80 a share. They're getting into a buy zone. Like I always tell you guys, if you've been following the channel for a while, always wait till BNGO's in that $5 range or even the $4 range, $4.50 to pick up some shares. So it's starting to get to that point where it's becoming attractive to pick up a good portion of BNGO because, in my opinion, I'm going to have the ability to sell it around $8, $9, or even $10 per share. Okay, so here we see an article saying BNGO is embarking on its ambitious plan to change the lab and diagnostic standard, putting the proceeds of the new equity offering into good use. Although the company has achieved high growth in Q1, it stems from a low base, making it harder to justify current price levels even if the revenue momentum continues. I think this article is written, by the way, when it was like $8 a share. So now that is becoming $4 or $5 a share, it's a little bit more attractive. I believe that BNGO has an aggressive investor base with a high tolerance for risk, opening an opportunity for capital appreciation if BNGO surprises investors with higher than expected growth. So basically, it needs that higher expected growth to impress the investors, and it obviously is a very high risk stock, but it has some long-term capabilities. Bionano stock has skyrocketed from 2021 after narrowly avoiding being delisted in 2020 due to its share trading below $1. Okay, a lot of you guys didn't know that. The company is commercializing Sapphire, which the Sapphire is like the biggest thing that a lot of the other genomic sector companies don't have. A novel approach to performing cytogenic and discovery research using optical genomic mapping as opposed to short or long form sequencing. So it's a lot different. The Sapphire is a specific thing. A favorable comparison to Pacific Biosciences long-forming sequences was one of the catalysts for strong share price outperformance. Sapphire is unlikely to replace gene sequencing systems in hospitals in research centers because it has fewer use cases, but it could become a must-have complement. Bionano stock trades at $6 when this article was written, a 65 discount from its 52-week high, which is $15 a share, and a 93% premium to its 52-week low, which was about 40 cents per share. I think that's where it's likely to stay for the next 6 to 12 months. So that $4 price point, $5 price point is a lot more attractive with BNGO because obviously the 52-week high is $15 a share, and we can definitely see it go back to those levels again for the long term, 6 to 12 months or even longer than 12 months. BNGO offers exposure to exciting high-growth themes like genomics and personalized medicine. BNGO offers competitive product in the cytogenic space that greatly reduces the inherent time and capital cost of genomic research, which is huge. They're talking about Sapphire. After a frenzied rally in late 2020, BNG shares have pulled back, offering yet another entry point for long-term investors seeking double-digit return potential alongside an attractive risk-to-reward ratio. So the lower it gets, closer to $4 per share, the more attractive that risk-to-reward ratio gets. Okay, the second stock on the list is Wish, and I think that this is a pretty good stock overall, down 8% on the week, down 2% in the month, 26% loss in the last 3 months. And since their IPO, they're pretty much down 57%, which is a big loss to be taken. They IPO'd at about $24 a share, which I think is reasonable for them to get back to those levels. Obviously, I want to buy closer to $7 or $8 a share. That's where they're most attractive. But I have started buying shares of Wish around that $10 price point. So what you guys will see here is, while its parent company is called Context Logic, for simplicity's sake, I'll be referring to the business as Wish for the duration of this article. Wish is a business and a platform has found a very comfortable niche operating internationally, targeting lower income purchasers who buy Brandy's products. While this is not a hyper growth story, this company has consistently led e-commerce app downloads for a few years. It led the app downloads for e-commerce. This is a company that has found a niche people love. The Wish Bowls have a lot to latch on to: a sticky platform, multiple revenue streams, large market cap, continued growth, a cheap valuation. Bears can latch on to high overheads and compressing gross margins. I'll explain why the Bulls will be right in the end. So he's saying that the Bulls will actually be right in the end, so that's an interesting thing to consider. Context Logic is much more than another shopping app. Management is making major moves behind the scenes, which we like to see. The e-commerce platform has billion-dollar annual revenue opportunity that almost nobody's talking about. It is the reason why I believe Wish can revalue significantly higher. Context Logic is slowly evolving into a smaller version of Amazon, with the potential growth revenues to $8 billion, potential revenues to $8 billion by 2025. Wish shred 27% of its market value since June. Buy the dip, this article says. Okay, so Wish has a lot going on under the scenes. We'll get into that more. And people think it's just a hype stock and, one of those meme stocks. It's really not. They have a lot more going on under the hood. This is a long-term hold that you want to hold until 2025 or around 2023 at the earliest. Wish is building out a comprehensive e-commerce platform ecosystem for merchants. Better products and vendors will come aboard with time as they execute. The new executive chair comp package features PSUs that will vest in the stock price is much higher than it is today. This stock reminds me in some ways of Etsy and Pinterest after they fell from their IPO prices before rising higher later on. Wish has seen an uptick in interest as a meme stock, but it can perform well even without this. So even without the meme stock stuff, it's going to still perform, but the meme stock stuff can propel it in the short term. So it also has long-term growth potential and it has short-term growth potential. So you guys have heard me talking about how Wish is one of my favorite riskier stocks in other videos, and I hope you guys are kind of understanding a little bit more why, and I hope you guys like when I do these deeper dive videos for you so we can talk about revenue growth and all the other stuff going on under the hood. Wish recently made its way to the Reddit meme stock buying mania, which propelled the stock from $7.75 to $15. However, Wish is unlike any other meme stock. Wish is a rapidly growing e-commerce platform that is serving underserved, value-conscious consumers. Even though Context Logic growth is set to flatline next quarter, the long-term growth story is intact, and positive free cash flow can be achieved over coming years. The fear, uncertainty, and doubt around Wish have led many to depress stock price. Okay, and even after the 50% plus move from its 52-week low, the stock looks undervalued. Due to the concerns about business quality and execution risk, I rate Wish only a modest buy at $12. Right now it's at $10, so that implies it's a really good deal from this article. Remember, I said between $7 and $10 is the best place to buy, and $11 isn't the worst place to buy, but obviously you want to load the boat between $7 and $10 if you're a long-term holder and you have the ability to hold on to 2023 or till 2025. Okay, and the last one we'll be talking about is SFT Shift at $8.20 per share. I want to pick up majority of the share prices under $7. So if we can get to that $6 mark, I'm going to be loading the boat on Shift at that point. Okay, now this is one that has been fluctuating pretty rapidly. As you can see, it might even be good for options because it goes up and down. It doesn't go up and down by much, but it does go up and down very frequently. Shift is kind of similar to a Carvana, but they're at a very much lower market cap of only 690 million. So this is the smallest market cap on the list, and it might be the smallest market cap that I invest in the stock market, implying that it is a little bit more of a riskier investment. But the 52-week low is $6, where I want to buy at, and the 52-week high is $14, where I think is a good place to sell at. I have a 2% gain, not many shares, 82 shares, but looking to load up a lot more at that $6 range. Okay, so the used vehicle market has exploded in 2021 due to consumer demand and supply chain issues for automotive companies. Shift Technologies is a young online car company that focuses on older and cheaper vehicles. Shift has executed well since adjusting to the pandemic last year, and forward guidance is promising. Cheap valuation, minimal coverage, and a concentrated product exposure makes Shift a strong investment. Shift is one of the most compelling ways to play the transformational change in consumer buying and selling patterns in the used car market. In the United States alone, the used car industry is estimated to be worth $840 billion per year, almost $1 trillion. And as you guys know, used car prices are going up and up and up, so it's probably even way higher now. However, this market is still highly fragmented, and e-commerce penetration remains below 2%. But in the future, that's likely to change, and that's why you have to get in this one early. There's more risk involved in this one, but it's something that you can get in on early, hold for long term, and hope that it does grow in the e-commerce, that used cars and e-commerce space go well together. End-to-end e-commerce platforms such as Shift, Carvana, and Vroom are revolutionizing the used car industry through the use of advanced technology. So Carvana and Vroom, if you guys know about Carvana, Shift is trying to become like one of the next Carvanas, or at least a competitor to Carvana and Vroom. And they're at such a small market cap, making it very attractive to see that if they can explode. In this note, I will share a detailed qualitative and quantitative analysis of Shift's business. Furthermore, I will provide my fair value and expected return estimate for Shift based on a very conservative assumptions. According to my estimate, Shift's stock is severely undervalued. So here you'll see an investment thesis, and if we scroll down a little bit, Carvana, Vroom, our interest over they peaked our interest over the last few months. We have previously presented detailed research on both Carvana and Vroom, as can be found here. However, after carrying out thorough due diligence, we concluded that both Carvana and Vroom were richly priced at $210 per share for Carvana and $49 per share for Vroom, respectively. Since then, Carvana has outperformed the S&P 500 by 2%, and Vroom has underperformed the S&P 500 by 40%. Even at current prices, I don't like their valuations. In my hunt to find a way to play the used car market opportunity, I have finally zeroed in on Shift. Before we go into detailed investment thesis, I would like to share a comparative analysis of Shift versus Carvana versus Vroom. You can actually see them compared against each other. If you want to look at their stock price, Shift is only $8.5. That's why I made this list. Carvana was once at Shift's level, $8.5, and now it's $278 per share. Their market caps are extremely different. Their 2021 revenue is extremely different. Their price to sales ratio is 1.5 times for Shift, which is very attractive. Their 2021 revenue growth is 200% for Shift. Gross margins need to get a little bit higher for Shift. Projected growth rate for 10 years, 50%. So it's projected to outperform Carvana and Vroom over the next 5 to 10 years. And here we'll see over the next decade, Shift is set to deliver rapid revenue growth, 200% year-over-year growth expected for 2021, combined with margin improvements arising from economics of scales and the addition of higher margin services. Since going public through SPAC deals, Shift stock has underperformed significantly after disappointing earnings report, significantly lower than GPU then provided guidance. In 2020, however, this price decline is an excellent opportunity to generate massive over the long term. The stock is trading at a 76% discount to its fair valuation of $35 per share. is what he considers as the fair valuation. According to my estimation, Shift can generate a CAGR return of 35% over the next 10 years. So I hope you guys can see why I like those three stocks. I dove deep into them for you. I hope you like when I dive deep and it opens up your brain a little bit and expands your investing theses, and maybe it gives you some ideas. Comment below which one out of these three are your favorite to invest in for long term. Let me know if you like these longer videos. Personally, I like these three stocks a lot. That's why I took the time and went over them into a deep dive and didn't just do a bunch rapid fire style. Typically, when I go deeper like that, I like the stock a little bit more, and I'm prepared to load the boat on all three of these stocks. I hope now you guys can see a little bit more why I'm invested into some of these stocks and my bullish thesis for these different stocks also. And keep in mind, there's usually negative articles, but when I was doing my research for this video, all I kept finding was positive articles on every single one of these stocks, which is a good sign, because typically when I do these videos, there'll be at least a few negative articles that I like to put in the videos. If you're a long-term subscriber, you'll actually see me put some of the negative ones in. But I was actually looking for some negative videos, and they're harder to find on these three stocks. A lot of analysts are very bullish on these three stocks in general, and they're extremely cheap. So I hope you guys enjoy that and you guys appreciate me going out of my way to find the best stocks under $10 per share. And if you want to see more of what I'm investing in, or if you want to become as good as me, I have a course where you can learn from me directly, and it's made for beginners. So if you're not the most advanced trader, don't worry. I developed it for beginners that know absolutely nothing. So you can learn how to do deep dives. You can learn to see if a stock is overvalued, what a PE ratio is, what earnings are, their revenue reports, and you become more advanced in the stock market and you make money. $17,000 I made in the last year, and just a week ago we were at like $20,000. So I will definitely get back to that $20,000 gain mark, and our account will be $55,000 again. Don't worry. So make sure you're subscribed so you can follow along the journey to $100,000 in my Robinhood account. Subscribe so you can follow along and see my thoughts on the stock market. Hit the thumbs up button if you enjoyed this video. Share with a friend if you think that they can see some value. And guys, I will see you in the next video. Remember, don't time the market, buy the market. Peace.